All right, let's get into this lesson. Today we are talking all about fair value gaps, how we spot them, how we use them within our trading. So the first two things that we covered was liquidity sweeps and breakage structures. Those were basically the essentials in order to be looking to take a trade in the direction of whatever our bias may be for the day. Fair value gaps can be used as your step one, like the liquidity sweep to fill orders, but they can also be used as retracements. So no matter what, after we get our break of structure, there is a chance that we are looking for fair value gaps after the break to retest just to confirm our entry. But we can also use the fair value gap as well to look for a potential opportunity to enter into the market before our break of structure. So before we get too carried away, let's talk about fair value gaps, right? First of all, we're going to look at how we can identify them. And again, it is a candlestick pattern, but only a 3 candlestick pattern, not one that you're looking to take a trade off of. We of course have bullish and bearish fair value gaps. The way we identify them is the exact same. The way they are used is slightly different. All right, let's find an example of a fair value gap. So as I said, fair value gaps are 3 candlestick patterns. So all we are worried about is 3 candlesticks on the chart. So we got a couple of examples of fair value gaps in here. So basically a fair value gap is easily spotted by this big bullish or bearish, like this one or this one, candle that basically has no wicks, no other candle wicks within that section. So obviously if I chuck this into replay mode at the minute, there would be nothing going on within here. It's basically like emptiness, which is pretty much what a fair value gap is. It is a void and an imbalance within the market. So how do we draw these up? As we can see, first candle, second candle, and third candle. This is a bullish example. And what we're going to do to mark it up is grab our rectangle tool, and we are going to start at the first candle. When we are looking to identify a bullish fair value gap, we put it on the wick, the high of the first candle, all the way through to the low of the third candle. We ignore that middle candle. Let me change this. We ignore this middle candle because that is where the imbalance takes place, and that is basically what makes our fair value gap, right? We have the 3 candles. All of these are bullish. They don't always end up being all bullish or all bearish. They can still create the imbalance within the middle. Basically, you just want to see if there is a gap in the candle's wicks. That gap between the candle's wicks is our imbalance and our fair value gap. So we have the bullish fair value gap here. We can play price forward a little bit, and we can identify a bearish fair value gap, which we can see right here. And as I said, these 3 candles are not all bearish. They're not all bearish candles, but they don't have to be. But of course, as we can see, we still have this void within those 3 candlesticks. So how do we identify the bearish fair value gap? We start that on the first candle again, but this time we start on the low, the candle's wick for that low. And then we move to the third candlestick where we place it on the high. So both of these boxes create fair value gaps. This one being bullish and this one of course being bearish. But what actually is a fair value gap and why are we looking to use them? So fair value gaps are imbalances within the market. At these certain points, there was, as we can see, a lot of buyers, but not a lot of sellers. Then at this point, there was a lot of sellers and not a lot of buyers. The market is of course constantly buying and selling. And at these points, there was a lot of buyers, for example, and at this point, there was a lot of sellers. So what can we expect if price is to move back within those areas? Let's get rid of this just for now. And as we can see, for this example, price moves back into a bullish fair value gap. And what happened here last time price was here? A lot of people, a lot of traders, banks, whatever, bought the market and made price go higher. So what happens? We fill into this fair value gap, then we can play price forward a little bit, and we can see the market goes higher. Similarly, putting our fair value gap back on our bearish example, we can see that at this point, there was a lot of sellers making the market go lower. As we can see, price trades up into that bearish fair value gap, and then we can play price forward as a little example, and price drops lower. There is a lot of sellers coming back into the market within this point, and a lot of buyers coming back into the market within this point. Now, of course, we can see fair value gaps literally everywhere in the market. And as we can see, for an example, this fair value gap did push price higher after tapping it, but then after coming back in again, we went past it. So there is of course ways that we can invalidate fair value gaps and not look to use them within our trading. So how do we invalidate a fair value gap? Basically, if a candle closes outside of that fair value gap range. So as we can see, I'll put my example back here again. Actually, let's use this one. There's a smaller fair value gap up in here, and we can drag price across. So this fair value gap is bullish. Price trades back within it. Do we take a trade as soon as the fair value gap is hit? No, we do not. Why? Because we need to see if the fair value gap is still valid. So whatever time frame you're on, say this is the hourly for my example, we want to see an hourly candle not closing past to keep our fair value gap valid. If the fair value gap closes past, if the candle closes past the fair value gap like this one did, this fair value gap is no longer valid. It's basically to be ignored, and we can just delete it off of our charts, make our charts look a bit neater. For the bearish example, you may have noticed that we did come very close to closing outside of the range, but as we can see, we did not end up doing so. We do wick outside of the range of that fair value gap, but as I said before, we are on the hourly chart and we want to see if we are invalidating a fair value gap. This is on the hourly chart. We want to see the hourly candle closing outside of that range. It can wick all the way up here for all I care. It doesn't matter as long as it closes back within the fair value gap, then the fair value gap is still valid. So at this point, you could have potentially looked to go short and then you would have had success coming down here. Now, as we can see, again, we don't have to completely fill the fair value gap because we have another bearish fair value gap over here coming from the 1, 2, 3 candlestick pattern, providing us with this imbalance in the market. Price comes up, tests it in this area here, as you can see right there, and then continues lower after hitting it, and then the market continues to go down a little bit. You could have taken a sell, right? This is how the market moves. As well as looking for liquidity, it also looks for imbalances within the market. So the market trades to fair value gaps and to highs and lows. That's how the market moves. That's where people's money is resting, and that is where a lot of orders get filled and cycled through. And it's kind of just like where a lot of shit happens within the market. So the market wants to trade to fair value gaps and liquidity points. So let's look at an example here of how we can use a fair value gap to actually execute a trade. So let's pretend that we had a sweep of some form of liquidity further in the chart. I don't actually know if there is, but for this example, we are looking for what comes after the sweep. Actually, let me mark it up. What comes after the liquidity sweep? We are then looking for a break of structure to the upside, a change in the direction of the trend. So what do we need to identify? The most recent high for this example, because we are looking to take a trade to the upside. So that is our most recent high, and that candle that pushes past and closes past confirms the break of structure. We are now bullish on, for this example, the 1 minute time frame. Now we see a strong candle like this. Ignore these fair value gaps. I know that they're there, but ignore them for now. We see a strong candle like this. We can expect that a fair value gap could be getting put into the market, printed into the market. If we play the next candle forward, we can see that yes, it is a bearish candle, but does it matter? No. Why? Because there is still this imbalance within the market, still a void of price, and a lot of bullish momentum came from here. We traded back down towards it. We didn't tap into it yet though. So we then have this fair value gap get set in. Now, as we can see, we retraced into that bullish fair value gap. Obviously not a lot, only a little bit, and then had a strong rejection out of that. We don't enter when it taps the fair value gap because we want to see if the fair value gap is actually going to be valid or not. This would have been a full candle coming down to here at the moment, and then it could potentially have just continued further and ignored the fair value gap completely. But as we can see, we had a strong rejection out of it. So that for me would be a valid reaction out of the fair value gap. In order to confirm my entry into the market, I would then look to potentially go higher. And as we can see, the market does go higher a little bit, and potentially you can take a trade off that. Just an example, right? This is also way off session for this example, which is the first one that I saw. So of course, matching the session times with the actual trading that you're doing is important as well, because why? We need to trade with volume. We learned this in the Blue Rose trading tier, but I think that just about covers fair value gaps. That's basically all you need to know. That's how we mark them up. That's how we can use them. It's kind of, for me, I use it more as a retracement tool after my break of structure, as a potential area that price wants to come back to, get a discount for the market makers, and that's where they can buy in. To confirm the move, we wait for a rejection up, for this example at least, and then yeah, that can confirm my entry. So liquidity sweep and break of structure, those are essentials. Fair value gap can be used as a retracement tool. Then I have the equilibrium and order blocks that we're going to cover next. Those are both also retracement tools. The fair value gap can also be used similarly to the liquidity sweep. I can't remember if I said this earlier in the lesson or not, but basically we can look to fill a fair value gap and then go lower and look for our break of structure, and then look for the retracement confirmation, all that. We get more in depth with it when we go over actually executing trades, but for now, this is how we look at fair value gaps. This is how we mark them up. It's It's how we use them. And yeah, go through some examples. Get some examples for yourself. You know what I want you to do? I want you to get 5 examples on 3 different time frames. So go on the hourly, find examples of bullish, bearish, fair value gaps. They can be either find 5, then find 5 on the 15 and 5 on the 1 minute. Why not? You're going to see a lot more fair value gaps on the 1 minute, and a lot of them will be getting invalidated because obviously they're 1 minute candles. They're not going to have that much impact on the market for the fair value gap. But do that. That's your homework. Lesson 3, I think it's lesson 3, is now done. We'll see you at the next one.